Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. You know, we're getting near year end, and there's so many different components to financial planning. Some are often neglected, and one that's neglected and usually given attention only at the worst possible time, actually, is taxes. And the reason I say that is taxes are given attention in our financial planning at the worst possible time, which is usually by April when we're filing our taxes, when it's too late to do almost everything or anything about it. All we're doing in February, March, and April is filing a report of what happened in the past. But what we're doing now on this show today is looking in advance while there's still time, this year before the year end closes, if there are tax strategies that we should possibly consider. Business owners do it, but individuals don't typically look at their taxes at all and just allow whatever's happening to happen to them instead of taking some control. And what I mean by that is, for instance, have you missed out on all the volatility that's going on in the markets today? And most of you watching will say, no, I haven't missed out on anything. I'm right in the thick of it. And I'll say as a financial planner, wait a minute. Are you missing out on the opportunities of the volatility? And you'll say, what opportunities? I'm losing money when the markets are going down. I just have to sit and wait. And I, as a financial planner with strategies, say that's not at all true. First off, there's a saying that we in the industry have, and it's never let a good crisis go to waste. And in your perspective, what that could mean is we have high volatility and sometimes lost positions. And what I'm here to share with you today, because we're not in April and we're not in March, when it's too late to do anything about it for this year, but we're actually in November. And we're looking at opportunities saying, are there strategies that we should consider now that might have positive effects and impact on our tax return that we're filing after the end of this year? Let me give you an example. I'll try to give you a lot of examples today. You know, we talk about IRAs. That is one of the few strategies that extends after the end of the year. After the year closes, it is possible to still affect and impact your tax return from the prior year if you make a tax-deductible contribution to an IRA up till the date you file your income taxes in April, let's say. You can still get a tax deduction as if that contribution was made in the prior year. So that's one of the rare strategies that can be made after the year closes. But how about this? Let's say we have stocks, and in your portfolio, you have stocks that you've held for long periods of time and are way up in value over what you initially paid. And let's say you might also have stocks that are way down. Let me take the one that's way down first. You have a situation, you paid $50 per share for your stocks on average, and they're worth $20 now or $10 now. The company is not doing well on whatever you have the shares in, and you're wondering whether to sell out or wait for the stock to come back. One, I guess, bit of advice you'd get from a stockbroker might be, hang in there, I think it'll come back. But a different set of advice you might get from a CPA, a certified public accountant, is, okay, you might want to hold that for the sake of where the markets are and where you are in the markets and to not take your loss. But let's consider this, the CPA might say. why don't you sell it and rebuy it? And you'll say, what do you mean sell it and rebuy it? And they'll say, why don't you sell it so that we can deduct the loss on your tax return and then rebuy it and wait for the markets to go back up? You'll say, oh, I didn't know we could do that. And they'll say, how much will that save in taxes? And they do the calculations and they say, it'll save you $500 in taxes, let's pretend. Because if you don't have any other gains on capital assets to offset those losses, you can only deduct up to $3,000 of losses, capital losses, from your ordinary income or your other income on your tax return in any given year. So it's up to $3,000 of losses you could deduct. And then any additional losses that you incurred get carried forward over to the next year and the next year, used up at the rate of $3,000 a year until they're exhausted. So you just call your broker back and you say, hey, I want to sell this stock, and you sell it, and the next day or the same day you buy it back, and he'll let you. He or she will let you. The stockbroker will let you. And you'll go file your taxes in April, and your CPA will say, oh, no, what did you do? And you'll say, I did what you told me to do. I sold my stock and I rebought it. So we can deduct the loss, right? And the CPA says, did I forget to tell you, you have to wait when you sell for a loss to deduct that loss. You're not allowed to rebuy the same security until after 30 days pass. So you're not allowed to sell and, well, why didn't you tell me that? Whoops, well, minor details. Well, it's called, when you look at that, it's called the wash sale rule, where when you sell, you can rebuy and wait for the markets to come back up. But to deduct the loss, you have to wait over 30 days to be able to rebuy that same security. So it's not horrible, but you better know the rules. So when this happens, it's possible, and have your CPA and your stockbrokers work together. It is possible to replace that with a similar security in the same industry. If you meet the IRS tests, you could use a different security so that if the whole market, let's say you're buying natural gas or energy or something like that, and you say, I'm afraid the industry will take off again, you could buy a similar security as long as it's not identical. So check with your CPA and stockbroker. Call us. We do all of this. And we'll work through the scenario to make sure that you're not out of that market for 30 days if you don't want to miss out and still capitalize on taking the loss. All right, so there's more detail to that. You're going to give us a call, have us work through it with you if you have an interest in that area. Between now and year end, we can do an analysis to help explore the opportunity if that type of strategy makes sense. Here's the next one. That, what I just explained, is called tax loss harvesting. Now I want to get into tax gain harvesting. Let's say we have a situation now, you have a security that you bought or inherited 20 or 30 years ago. You've held the stock and you paid $10 for it, let's say, or you inherited it and it was worth $10 at the time. And now it's $100 a share. So it's done very well for you. And the stockbroker, you might say, hey, is it time to sell the stock? And they'll say, no, we think it still has more time to go. So you call the CPA and say, should I sell the stock? And they'll say, oh, no, it's capital gains. It'll impact your taxes too much. But I'm a certified financial planner here to say that in merging the skills across different disciplines, taxes and investing and the financial planning component of this, I'm here to share something with you. If you sell at a gain and it's something you've held for longer than a year, it's a capital asset, which is a stock. Typically, you are subjecting yourself to a more favorable tax rate, a capital gains tax rate of around 15%, maximum capital gains rate, unless you're in the very high income tax bracket, when it could be 20% maximum capital gains tax rate. But I'm going to share a secret with you. Almost everyone listening to the show and watching on TV is probably right now in the 15% ordinary income tax bracket. What I mean by that is you're in the 15% tax bracket now. The rule for capital gains is kind of exciting, and it's not much talked about. If you incur a capital gain and your accountant's saying, don't sell that stock, you'll incur up to 15% capital gains, I, as a financial planner, am going to say, wait a minute. Look at their tax return. Look at your tax return. You're married. You don't earn more than about $75,000 a year taxable income, which could be $85,000 or $90,000 joint combined income. You're in the 15% bracket after your write-offs, standard deduction or itemized deductions and personal exemptions, things like that. When your taxable income is less than $75,000 and you're married, and then you sell stocks, let's say it's $50,000 or $55,000, you're well below the limit, and you sell stocks with an $8,000 gain, let's pretend. That $8,000 is taxable as a long-term capital gain. That's true. And the maximum capital gains tax for that typically is 15%. But folks, if you're currently in the 15% tax bracket, the capital gains tax can be zero. That's right. If you sell a stock and your income tax bracket is the normal bracket, not a high income tax bracket, but a normal bracket, it's possible your capital gains tax rate might be zero. I know most of you have never heard that or been told that, but that is the normal capital gains tax rate until the amount of capital gains push you into a higher rate. So doesn't that open up for a strategy where at the end of the year, if I teach you this in February, it won't do any good. But if I teach you this in November, you need to call us, get us to review your overall situation, not just your position in the stock market, waiting for stocks to come back or waiting they're high and you don't want to sell because you'll owe tax. You need to inquire, is it possible that you could sell out of gain positions up to certain limits and pay no tax? Could you get out of them tax-free? This 0% bracket for capital gains has not always been here, and it's not always going to be here. So we have a window of opportunity that will close. And should we examine your personal situation to see if this is applicable to you, that you can reposition holdings in your portfolios without paying tax. Normally they're not taxable until you sell them. But is it possible to sell and rebuy? Now remember, I just said the wash sale rule, you have to wait 30 days and you'll say, well, this stock's on a tear. And what that means is it's going up fast. And I don't want to be out of the market on this particular security for that 30 days. I don't want to wait. Well, here's another secret. The wash sale rule only applies to losses. And you've got to be saying by now, why hasn't anyone told us about this before, this type of planning? Well, you don't have a certified financial planner, that's why. The wash sale rule only applies to losses. So if you have a gain position and you maximize your gain position, what you're doing by selling is resetting your cost basis now when you rebuy. And yes, you can rebuy an hour later. So if you want to deduct the loss, you cannot. If you want to capitalize on a gain and then reestablish your cost basis at this new $100 level, that means if they ever change the tax law, and they will, and makes all capital gains taxable now once again, no zero bracket anymore, you've gotten out all of your up to the $100 value in gain tax-free if it works for you, and then you reestablished your position, that you'll only owe capital gains on everything over $100 now, because you got out all of the gains prior to $100. And if you apply the strategy right, and if it works in your situation, you might be out at number one, a more favorable capital gains tax rate of 15%, or number two, you may have benefited by getting out at the lower capital gains tax rate of 0%. Why? Because you watched this show, that's why, and you took advantage of it. Every year at near year end, you learned by watching this show, we should do tax planning near year end. And this is one of the strategies. Now, here's another one. We look at a lot of the holdings that people have, and companies and business owners and all types of things. And we look at a situation where in your estate planning, you might have a portfolio with gains and losses, but I want to share something with you. What about all these gains? If you could not capitalize on these during your lifetime without incurring exorbitant taxes, onerous taxes, we would call it. You'd say, we've done an analysis and you are trapped that if you sell any of these gains, you're going to pay exorbitant capital gains tax, or worse, the alternative minimum tax. I won't get into that on this show, but let's say we do the sophisticated analysis, say we cannot apply these strategies, but you're holding these securities that ultimately someday, when they're sold, will be taxable, and it'll be a high rate of tax, let's say. Okay, I'll share another secret. It's called the step up in basis at death. So if you say, I'm holding these assets as a legacy asset, these are for my children or my grandchildren, we don't need the money. We're trying to accumulate an estate that if we ever need to go into a nursing home, maybe we use these resources. But if we never do, we want them passed on to the next generation. So you'd ask us as financial planners, what are the most efficient ways for us to, number one, accumulate assets, and number two, distribute assets for legacy planning purposes? Which are the best forms for us to hold assets? Would it be in an IRA? Would it be in a Roth IRA? Would it be in a non-qualified account, just regular stocks and bonds, etc.? Should it be annuities? All those types of questions. So we would look at that and we would say, guess what, Mr. and Mrs. Jones? We will share this with you. Any accounts that you hold in a non-qualified account, which are regular stock and bonds accounts, let's say, not held in IRAs or any qualified retirement accounts. Remember, if you sell all those stocks, they're going to be taxable. So that's why we chose in your income tax bracket to not sell them at this time. At the time of your death, the kids or charities or whatever can inherit those stocks, for example. They don't have to sell those stocks. Unlike other assets that must be sold sometimes at death, stocks aren't one of them. So you have a stock portfolio and your kids can actually inherit these stocks themselves and continue ownership of them. Well, guess what? There's what we call a step up in cost basis in the current tax law. What it means is whatever your stock value was at the date you died, that is the heir's new perceived cost of what they actually have into the security. And it's established as their cost basis is actually the whole value, not the $10 you paid for that $100 stock. If you sold it the year or month before you died, you would owe tax on the $90 gain. If you die and they inherit the $100 stock, their cost basis is now $100. It immediately steps up the cost basis upon death to what the whole value is. And guess what that means, folks, in plain English? The person holding a stock only pays tax on any gain that exceeds their cost basis in the security. Did you hear that? So now, they just inherited your $100 stock, sell it the next day, and they don't owe any tax. You beat the IRS. Through the step up in gain, you did no tax, but you passed on a gift to them that now, because they inherited it, instead of you selling it in advance, they don't pay tax either. You beat the IRS. In the tax code, by using that tax code, which is called a step up in cost basis, written right into the code, but you were smart enough to know how to apply the rules. Why? You have a certified financial planner on staff. That's why. How expensive is it to have one? I don't know. How expensive is it to not have one? I don't know. Only you can make that decision. Here's one final thought. We're dealing with year-end tax planning. There are a lot more strategies than these. I can't go over them all on the TV show, and the radio show. But here's a final one. Let's say you have a $100 stock that went to $2. Oh boy. If you sell it now, you take a loss. But remember, I said you can only deduct up to $3,000 a year, unless you have other capital gains to offset it. And I won't get into that in detail. But let's pretend you don't. So you have maybe $100,000 in losses, let's pretend. You can only deduct at $3,000 a year. The rest are loss carry forwards, which will take seemingly forever. And you're already 75 or 77 years old. You may never make it. Folks, listen. If the kids inherit the stock, they inherit the stock and their basis becomes the value at the date of death, remember? So in reverse, their basis isn't the $100, your basis. That's not how it works. Oh my goodness, what do we do? Well, there's another rule that in gifting an asset, you are in essence in a lifetime gift. You are gifting the asset and they retain your cost basis. So I want you to give us a call and find out if you have any loss positions or your parents do. Talk to them about this and say, hey, there are tax strategies. We may need to maximize the holdings. You know, we're going to inherit the stock. These are loss positions. Maybe you should gift the stocks to us in advance so that we protect the high cost basis and we can continue deducting the losses year after year after year after year after you die and we inherit them. Because if you don't and we inherit those, we lose all of the losses and so did you. So we apply the step up in basis on gains, but we might apply a gifting strategy during lifetime on losses to pass the tax advantages on to our kids. So either way, we're working within the tax laws to help zero out your income taxes where you otherwise don't know any better. And that's our job as a certified financial planner, to help you evaluate all of your strategies, not just singular strategies on investing, but rather all of your strategies in a comprehensive financial planning outlook. And that's what you want to try to do. So it's near year end. I wanted to pique your interest on, yes, you do have more control over what happens to you than you think. Thanks again for tuning in to another edition of All Things Financial, and I'll be back again next week.
Securities and investment advisory services offered through SagePoint Financial Inc., member FINRA SIPC, and registered investment advisor. Insurance services offered through Driscoll Insurance and Financial Services Inc., which is not affiliated with SagePoint Financial Inc.